Hello, my name is Peter Sleep. I'm the portfolio manager of the AAP funds. The AAP funds are a suite of portfolios brought to you by Seven Investment Management, with the Seven Investment Management asset allocation executed through passive funds. The idea of these funds is to try and maximize the return available to you and minimize the risk to your customer. Let me just drill into how we execute this strategy. You can see on this page we've got one or two ETFs, one or two tracker funds, and one or two other portfolios which combine to give you our European and emerging market exposures. In the emerging markets, you can see, starting from the bottom, the DBX MSCI Emerging Markets ETF, which makes up about 1% of the portfolio. You can also see the BlackRock FT Emerging Markets Tracker Fund, which makes up about 1.5% of the portfolio, and the RBS MSCI Emerging Markets Note, which makes up 2%. This is a note brought to you by RBS, which gives you the emerging market returns plus 40 basis points. So here is an area where we're able to add outperformance, get locked in, guaranteed for 2 to 3 years from RBS. In the UK, you can see, going back right up to the top, you can see we own a portfolio of UK equities. We used to own ETFs and tracker funds in this part of the portfolio, which cost 30 to 40 basis points a year, but now we've bought the underlying shares and sold the ETFs, and we save 30 to 40 basis points a year on that part of the portfolio, which passes straight through to the fund shareholder. Similarly, in North America, we used to own the ETFs. The ETFs have been sold. Those cost us 30 or 40 basis points, and we own the underlying individual shares and save the customer 30 to 40 basis points, money that goes straight back into the fund. In the alternative space, you can see we have a range of ETFs and other structures. In the hedge fund part of the portfolio, we own a range of listed hedge funds, which we buy on the stock market at 10 to 20% discount to NAV. So we can participate not only in the returns of the hedge funds, but we can also hopefully participate in the uplift from a discount to NAV over the next few years. In Timber, we own the iShares ETF, but in private equity and infrastructure, we've sold those ETFs and we've bought the underlying shares, relatively small number of underlying shares, which saves that part of the fund 60 to 70 basis points a year, which we pass straight back to the fund. What is the due diligence thought process I go through? Well, here's some of the points I look at. Everybody else will be slightly different and will have recommended different ways of doing it, but this is the way I do it in my own mind. Of course, regulation and compliance is the most important thing, and no presentation would be complete without talking about that. I won't go into them in great detail. I'll just say that these regulations are there to ensure that I don't invest rashly, I don't invest too much in any particular vehicle and make myself illiquid to the fund. Tax. Again, you should seek your own tax advice. Everybody's tax circumstances are slightly different, but I will say that you should make sure, if you're a UK investor and you are tax sensitive, please make sure that all your ETFs and tracker funds have reporting or distributed status. If you don't do this, any capital gain you may make will be taxed as income. Moving on, when it comes to choosing between tracker funds or ETFs, I'm kind of agnostic. Tracker funds tend to be cheaper, they're simpler, and they generally have daily dealings, but there are upfront costs, which I'll go into in a moment. ETFs, you have a great deal of choice, much better intraday liquidity, but you do have this issue of counterparty risk. Tracker funds, I mentioned to you high upfront costs. How does that arise and why should you be aware of it? Well, personally, I don't mind paying an upfront cost if it is related to my costs only. I do find that tracker funds that don't have an upfront cost tend to have higher tracking error. I think it's something you need to be wary of. Let me give you this example of the Vanguard UK Equity Index. Now that has a 15 basis point TER or AMC, but a 50 basis points upfront fee, which deters many people. But that upfront fee there is to cover the cost of your stamp duty when you buy the UK market. This is something you cannot avoid. The UK government charges you 50 basis points every time you buy a share in this country. So when you give your money to Vanguard and they go and buy shares on your behalf, they will incur a 50 basis points fee, which they pass back to you. Now you can see that the tracking difference with the Vanguard fund is in line with the TER or the AMC. The AMC is 15 basis points, the tracking difference is 17 basis points. It's only 1 year, but it does give an indication that they are in line. Contrast this with a Fidelity Money Builder UK fund, where there's no upfront fee. The fund bears the costs of your stamp duty. That's great when you go in, but it means that you, once you're in, will bear the cost of everybody else's stamp duty that follows you, and you'll go on and on paying other people's stamp duty every year. This comes through in the AMC and the tracking difference. The AMC is only 10 basis points, but the tracking difference over 3 years is 110 basis points. That's because of the drag caused by stamp duty. So do be careful. I would personally much prefer a small upfront fee that is reasonable and covers my costs than a free, supposedly free, no upfront fee fund. Moving on to whether I prefer physical ETFs or swap-based ETFs, I have to say that I'm agnostic on this. I think with physical ETFs, you get greater simplicity, but you do get limited choice, and you also do tend to get greater tracking error, as David Patterson perhaps demonstrated. With swap-based ETFs, you get much greater choice. You do get perfect tracking, less fees, but they are difficult to explain, and you do have this issue of much larger issue of counterparty risk. Counterparty risk is the risk that a party to a contract will not live up to its contractual obligations. Counterparty risk is around us all the time. What happens if the bus breaks down? When you step onto a bus, you enter into a contract with the counterparty. Now, there is a risk that the bus company will not deliver on their contract. How do you address this? Well, you can never completely eliminate it, but you can take reasonable steps. In the case of the bus trip, perhaps you have a bus trip to an important meeting or to work, you might perhaps leave slightly earlier if it's an important meeting. You might, at the back of your mind, have alternative routes mapped out. Perhaps you might walk the last part. Perhaps you might catch the tube. Perhaps you might catch a taxi. The important thing is that in your mind, you have addressed the risk. Similarly, it's how you address the risk, the mitigating factors of counterparty risk in ETFs that's important. And there are a number of statutory things there that you need to bear in mind. For instance, there are the UCITS protections. No more than 10% of the NAV of a fund can be locked up in derivatives. Generally speaking, swap-based ETFs are backed by collateral and in some cases over-collateralized. There's the nature of the collateral and there's a financial strength of the counterparty, the swap counterparty. Is it a large bank or is it a small bank? Is it some other vehicle that is the swap counterparty? Each ETF is different and you need to bear that in mind and investigate as you go along. As I say, each ETF is different. There's 3 different broad models that you've heard about today. There's the physical model, companies like iShares, HSBC, perhaps Credit Suisse First Boston. There are unfunded swaps from companies like Lixor, Source and Amundi, and there are funded swaps. The type you've heard about from DBX, there's the funded swaps from ETF securities, and iShares now have 2 funded swaps in the UK covering India and Russia.